Hey guys, welcome back. So jumping back in for another tax video. I know, fun. Again, save money. Don't want to waste money on tax. I mean, you do. Tax is very good. We like tax. Um, but here's another way, HMRC approved for saving money through taxes on what you can claim for loopholes or benefits or reliefs on the taxes of being a landlord. All the recent stuff coming out right now, I'm going to show you what's going on. Some of the most important parts of being a tax smart landlord. So many landlords end up paying a lot more tax than they should, just simply because they're not clear on what they can and can't claim. So I'm going to break down what counts as an allowable expense and what doesn't, and how Section 24 affects mortgage interest and how good bookkeeping really matters. Some of the most important parts of being a tax smart landlord. Ordinary expenses versus capital expenses. HMRC allows landlords to deduct a wide range of business costs from the rental income, but not everything will qualify as a deductible expense. So things like maintenance and repairs, but not improvements. So buildings and content insurance, utilities, council tax, if you pay them as a landlord letting agency, management fees, legal fees for short rents, accountancy fees, direct costs such as advertising or phone calls. You can also claim vehicle running costs or travel expenses, but only if they're wholly exclusively for the rental business. For example, visiting a property or meeting a letting agent, but you can't claim capital improvements. So anything that enhances or upgrades the property beyond simple repairs. For example, replacing a broken roof tile is a repair, but replacing the entire roof with a better quality one is a capital improvement. The same goes for mortgage payments. You can't deduct the full amount, only the interest element qualifies for relief. If the property is owned in your personal name, then that relief is restricted, and we'll get to that in a minute. But if you own your rental through a limited company, the full interest is deductible as a business expense. And finally, personal expenses are never deductible, even if they're related directly to your rental. Replacement of domestic items relief. So since 6th of April 2016, landlords can claim replacements of domestic items. So this will cover the cost of replacing furniture or appliances or household goods, things like sofas, beds, fridges, and crockery, as long as the new item is like for like of the replacement. So if you swap out a broken washing machine for a similar model, that's deductible. But if you upgrade it to something bigger, better, and more expensive, then only the equivalent cost of the original item will qualify. So Section 24, mortgage interest restriction. So let's talk about Section 24. A major change that's still catching out landlords. Since the Finance Acts of 2015, landlords can no longer deduct mortgage interest from their rental income directly. Instead, they receive a 20% tax credit on their finance costs. For every £100 of mortgage interest, a higher rate taxpayer only gets £20 of tax relief. That's why many landlords have responded by moving properties into a limited company, or switching to service accommodation, or transferring ownership to a basic rate spouse. If you still hold property personally, it's vital to factor restricted relief into your cash flow. Otherwise, your profits on paper might not reflect your real world returns. One simple strategy is to reduce the mortgage borrowing rather than chasing the high leverage, especially if the tax credit eats into your margin. Bookkeeping is key. If your rental receipts are under £150,000, you can use the cash basis for property basis income. That means that you record the income you receive as rent, and the expenses when you pay them. It's very nice and straightforward. However, under the cash basis, you can't claim capital allowance on parts of machinery. If you spend heavily on fixtures, fittings, or equipment like computers or office furniture, you might prefer the accruals basis to claim those allowances. Either way, keep solid records, invoices and receipts, mileage logs, everything. HMRC can ask for evidence at any time, and being organized helps you claim confidently and correctly. So, Fred owns 3 buy-to-let flats, generating £45,000 in rental income. He spends £8,000 on repairs and insurance, £2,000 on letting agency fees, £1,500 on service charges, £500 on phone and travel, replaces a sofa for £1,200, and here's how it plays out. So Fred claims these regular costs as deductible regular expenses, and the sofa under replacement of domestic items relief. His finance costs are £10,000. So under Section 24, he receives a 20% tax credit worth £2,000. So that brings his tax rental profits from £45,000 to £31,800, with a £2,000 deduction in his final tax bill. Without any proper record keeping, she could easily have missed several of those deductions and overpaid on tax. Okay, so the takeaway here is simple. So every pound that you spend running your rental business could be a potential reduction. If it meets HMRC's rules that you keep good records, different types of expenses, ordinary, capital, or replacement, are treated differently. And Section 24 mortgage interest relief is not what it used to be. But with the right careful structure and timely planning, you can make sure that you are able to claim all of the expenses and keep more of the rental income in your own pocket. Thanks for watching, guys. So that was just a few of the structures and different things that you can make work to your own benefits. It's really important that people do understand how tax works around property, just to make the most out of their own business, to keep the most that they can in their pocket. It's always good. Tax isn't always bad. Sometimes they are looking out for us in some way. So by giving us these kind of structures and schemes to help landlords try and retain as much profit as possible, we got to make sure that we know everything that's going on just to stay in the loop, and otherwise you're just going to be missing out. Why would you bother doing that if you're not going to be up to date with what's happening with tax? So thanks for watching, guys. See you in the next one.